I'm Eric Chemi, and this is Politely Pushy. Excited for my guest this week because we both have a New Jersey connection. Kelly Ford is a tech industry veteran turned growth equity investor. She's at Edison Partners based out of New Jersey, not too far from me. So this is a fun one for me to talk to someone kind of local, driving distance away. Kelly, you've been busy today, flying. I think you're in Nantucket now. You're flying. You're on the go, right? Like this was like I think you just got to the recording location a minute ago. So this is the life of a big time investor. Not as my life's not as fast paced as yours. So I'm curious, like where you are, what have you been doing this week? How much travel is involved in your job on a day to day basis? And thanks for making time to talk to me today.
Oh, thanks. Good to be here. Um, I didn't travel at all this week, except just trying to get here.
Until right now.
Yeah, it's raining here, and it's been in a drought, and I still have. I can still feel the raindrops on me. So
you look dry, right?
Literally just arrived. So,
the great thing about being in 2D, right? Being on a camera is the camera doesn't see humidity. It often doesn't see rain a lot of the time too. So you look like you've just been in the sun the whole day.
We made it, yeah.
Talk about the switch from operator to investor, right? There's so many memes and myths and ink spilled about one life versus the other, one job versus the other. What are the differences that you've noticed? What are the skills that transferred? What are some of the skills that didn't? How and why did you make the switch? Was it an active, I need to go do this? Or was it, I kind of fell into it? And that was a lot of questions.
Yeah.
So let's start simpler. How did you end up in it? Did you actively seek it out or did you accidentally fall into it?
No, it was totally an accident or, sort of serendipity, happenstance. I actually worked inside a former Edison portfolio company, and our managing partner, Chris Sugden at Edison, was on my board. So I had some connectivity to Edison. I knew what it was like to be inside a company that Edison backed. But flash forward, a few years later, I found myself living in Princeton, and on a Saturday running into Chris Sugden, and he's, we kind of looked at each other like, what do you, he said, what are you doing here? And like, I live here now. And he said, we're a different firm than what you knew us. We evolved our strategy from venture to growth equity. We need more operating experience. You need to come work with us.
So, talk about that difference. I wanted to get into that growth equity, because I think a lot of people, they may not know, right? They know, they hear these words, they hear VC, they hear PE, they don't hear growth equity as a phrase as often. Talk about what that difference is, right? From venture to growth equity and how they're not exactly the same.
Sure. So venture simply it takes great product risk. Product and technology and getting the product to snuff is a significant use of proceeds of the investment. Venture capital investors tend to make a lot of bets, commonly a lot of smaller bets. So, there's high risk and typically high loss rates. And they'll look for, one or two investments to kind of return the fund, just place a lot of bets and go from there. And then there's, conversely, so VC lower in the chain, PE higher in the chain, private equity, majority stakes, big checks, much more concentration, fewer bets, much lower risk appetite, focus on profitability. There's usually more use of debt. Where we are is in the middle. So we are top line growth focused as a growth equity investor. We'll do minority or control. Go to market as the primary use of proceeds. We're not taking product risk. There's always some level of market risk, but we're also, we don't view it as taking market risk per se. We're taking execution risk. And as a result, there's placing a modest number of bets, having a concentrated portfolio of, folks that are going to be modest to outsized winners. And, as a result, much lower loss rates. So we'd underwrite per fund generally, below 15% loss rates. And we're well under that with our current funds.
Talk about then I'll go back to one of my earlier questions when I asked too many at the same time. The skills that translate, right? The operator to the investor translation. What are the skills that you've brought with you? What are the skills that you've left behind? And maybe some skills that you had to learn in this new job?
Sure. Well, the first thing was, and I think that got me really excited, was tremendous relevance and translatable, experience, I guess, relative to the stage of company where we invest. I've mostly only worked in kind of that, 10 to, or even, I mean, we don't invest pre-revenue, but we 10 million revenue to 100 million in revenue stage was something that I've done repeatedly and was very comfortable with. Another piece of it, which was less about my experience in, the sectors and the stage where we invest, or even as an operator working in those companies, but I have a history of taking on positions that nobody's ever held before me, and this was that. So I'm
you're not replacing somebody in a previous
never,
job, but
no.
the job is being created basically for you.
Yes, and that has been the common thread since I got out of college.
So you don't even need a resume. It's like, it doesn't matter what I've done because no one else has done it. And the job you're going to give me, nobody else has.
We're just going to create we're just going to build something new. So I'm a builder. It offered me the opportunity to leverage my experience building and growing companies at this stage in related sectors. And it allowed me to, where my gaps were, I never thought I would, be an investor. And coming in as an operator and the team valuing my background, I was able to plug into every stage of the investment life cycle. They welcomed me in with open arms, and I was part of every new deal team. I was able to advise company at different stages of growth. I inherited board seats eventually from my colleagues, and then led exit processes for many of those. And then that all sort of transitioned into actually leading investments and putting capital to work.
Edison's interesting. Your background's interesting because the typical stereotypical firm, it's people that went to school in the Bay Area, they work in the Bay Area, they invest in companies in the Bay Area.
They got the MBA.
We know what that looks like, right? You went to Michigan State, you work at a company based in New Jersey, and you all invest in companies specifically not in Silicon Valley. Talk about that. And are there areas that are really hot, really growing right now that maybe the general public doesn't have their eye on that part of the radar?
Sure. I think more than 70% of our active portfolio, and this has been consistent over the last couple of funds, and certainly in our current fund when we're investing, these companies are based in what we called underserved markets. And certainly there's more capital kind of sloshing around out there in recent years than historically, but we've been investing in these markets for 36 years, even when we were venture investors. So, pockets of the Midwest, the Southeast, there's even markets within Texas that are, or had been underserved. For us, it's, I think the profiles of these companies, first and foremost, have always been appealing. These founders have built customer funded, capital efficient businesses, and they've managed to squeeze out decent growth in many of which have not raised capital before. And if they have, it's like less than $5 million, and they're certainly generating far more revenue than they've raised in capital. So we like that profile. We like that mindset. The locations, even just recent investments, believe it or not, all the household name tech companies have some presence in Birmingham, Alabama.
Really?
You do not think of it as a tech hub, and there might be offices or there might be a high concentration of employees who are working remote. But that's, we think that's an exciting emerging market. We invested in a company called Prepaid Technologies recently. So Fintech in Birmingham And there's actually an interesting developing kind of tech ecosystem there. And like all the great, tech markets that emerged at some point in time, there's some lag from the larger tech companies, people having successes, um, trickling into smaller companies and startups. Shipped was in Birmingham, right? And Target acquired them. Personal shopping and delivery company. I think they have like 6,000 employees or something, and they're primarily based in Birmingham. And there's a handful of others. So we like Birmingham, Nashville, Indianapolis, Charlotte. We have investments in some of those markets, multiple investments over the last couple of funds. So those secondary markets, you know, the locations too. Places that are reasonable to get in and out of, low cost of living, legacy maybe of logistics or banking or healthcare, or even some of these larger tech companies. Those all make for great markets, places to live and build businesses.
You mentioned fintech. I was going to ask about that. Are you seeing a recession from your data points, your point of view? Are you pulling back in areas like fintech? I mean, we know certain places like healthcare, IT, there's certain types of enterprises that they do well regardless of the economic environment,
Yeah.
education, health. Fintech seems like one that's it's more sensitive. What's your look at some of these different verticals? Are you pulling out in certain places?
Yeah, it's less about pulling back from our focus sectors because, fintech, I think a lot of vertical SaaS spaces that we're in, healthcare IT, these are long game sectors for us. We've been in them for, as long as the firm's been around, even as a venture investor and now as a growth equity investor. And we've also been in them through multiple cycles. So we're, we're pretty bullish on the sectors we've chosen, and certainly we evolve themes from time to time. I think for us, it's more about valuation discipline. And I think the good news is in this market and the threat of, an increasing downturn, maybe markets are starting to rally again. It might be a blip, but, we'll see. But I think the good news is CEOs and bankers and are waking up, to the fact that great companies or any company out fundraising can't command the multiples that they were over the last few years. Great companies will still trade on fundamentals and there'll be premium multiples, but more on average, you're going to see 5 to 8x multiples rather than 15 to 30x, and on revenue anyway, where we focus. So even in fintech, the public markets have not been kind, but we remain bullish and we still have active deal flow and pipeline in categories in fintech. We haven't pulled back at all.
Has the downturn, let's call it, whatever this thing is, the last 6 to 12 months, has it helped you from an investor side? Because Wall Street Journal had a big front page story this week. The power's back to your side of it, right? A year or two ago, the companies had the power. Everyone was throwing money at them. The valuations were high, like you said. And now it's, hey, we're structuring these deals in our favor. You're getting a lot less and we're getting more. We're getting more control. We're getting these other, wordings in the contract that favor us. Are you using that leverage, right? In the arm wrestling match that this is, are you putting a little bit more pressure now this year compared to last year when you're looking at a possible investment?
I mean, you still have to, for great assets, you still have to be competitive, and, some structure just may not be accepted, certainly from seasoned CEOs who have raised capital before, or just really, know who can get creative like we can. Um, when folks are looking at forward revenue multiples, and you know, even still 12 months, 18 months, what have you, and they want to be paid on that, um, we might get creative on performance structures that, are that work both ways or work one way. We are still getting, certain structure on deals that we always have, but we also, we'll trade it away for. It just depends on the company and in the dynamic. But we're pretty disciplined on valuation. We do. We're a pretty creative team, so I feel like we can always find a way to get there with the CEO, and it's always aligning on what we're playing for. It's not on what happened on the last round or FOMO because somebody else in the space got this multiple or that multiple. It's a very kind of individualized thing, but I mean we're not playing games. It's a it's we're playing for it's a long game, and the relationship is as important to us as getting the right deal. And I think if you come in too heavy-handed or one-sided, it's probably not going to work out anyway, right?
From your perspective, when you see the news items like what SoftBank's been up to or not up to the last few months, the Klarna valuations, when you look at sort of the outside news, how does that not necessarily affect you, but what's your reaction to that? Is it just like you roll your eyes like, yep, I saw that coming? Or is there some surprise when you see some of these real negative downturns from some of these big names?
I mean, I go to I go to strategy drift. I go to poor governance. I think it's hard to not pay attention to it, but it's also not really our world.
Right.
So it doesn't affect how we operate every day. We're super disciplined and have good governance in our funds and with our LPs and in our companies. So we wire up the governance, place heavy importance on board, the right board construction. We feel very strongly the board is your strategic weapon. It's governance, but it's also your strategic weapon as a company.
Right, use it, take advantage of it, make it be helpful to you and not just a roadblock or just part-time people who sit there and come to meetings and do paperwork.
Yeah, it should. A great board and good governance gets you out of the news in these ways, but it's also, I mean, it's also a true strategic lever and even a personal lever for the CEOs. And we're big believers, and because we're investing in companies at times who haven't raised capital before or raised very little. It's not uncommon. We just approved a cybersecurity related investment this week, and they don't have a board, and they're sizable revenue to in growth rate, and a lot of really exciting things happening in the business, but that part of their business wasn't very professionalized, and we're putting a lot of focus on it before we close.
Before you get the money, we're going to fix this.
Yeah.
Do you, right now, are you helping your investment companies, your portfolio companies, are you helping them think through, hey, let's watch cash. Let's maybe think about not doing certain expenses. Has there been a different conversation this year around, we're going to help advise you to make some leaner decisions than maybe you would have done 12 months ago?
Yeah, for our high burners, for sure. And if anybody who's growing a little slower, high burners who've enjoyed, robust growth rates year over year, we're saying, hey, listen, you're a 40, 30, $40 million revenue company growing 60%. Do you need to grow 60% this year? What if you grew 40 and, you took down your burns? So we had a discipline. I think
but it's interesting. Like I'll just pause for it. So it's interesting. It's like, let's slow down the growth, right? Like, because everyone's always saying grow. It's like you're growing too fast because you're spending too much money to get there. We'd rather save a little bit, like a little Goldilocks. You grow pretty well. You don't waste as much money, and we can keep growing for futures. I'd rather have a 40, a 40, and a 40 than a 60 and a blow up. Yeah.
100%. I think extend the runway. It gives yourself optionality. We looked at high burners. We said, listen, this is going to be probably an 18-month thing. Let's make sure you've got cash into 24. We can always change the plan if we're not seeing, the downstream impact, but let's get ahead of it. And so the high burners in particular, but even the folks who weren't burning as much, like there's ways, maybe you lost an employee or two and you're not going to backfill, right? Like rethink the org and what you need to get out of it. Um, so I think that's, even for folks who have the runway, they're still being mindful and making choices on things like that. Like, let's choose not to backfill positions. But we have 700 job openings across our portfolio.
Really? Because I was going
And
to ask about jobs. Like, where should people be moving? If you just got laid off, or let's say Coinbase rescinded your offer a couple months ago, where should people be looking if they're in the tech industry? Do they need to move to Birmingham? Do they need to have a certain type of skill? Where are these 700 jobs available?
I think candidates, it varies on maybe location, it varies on the level of position. um, I think everybody is sort of reevaluated, and you know candidates have their must-haves and their nice-to-have considerations, right? So if you're someone who's enjoyed developing a career, or you want a career in a high-growth tech company, well, you know you're probably looking at recently funded companies that would suggest decent fundamentals, and in a strong big market, and momentum of open positions and hiring, and um, adding to the senior executive team. Like, there's all these signals in the market, and you can assume they've just raised money, so they probably have decent cash, and you probably have room to move in your job, and what you can do and how you can contribute. So that's just a characteristic of a company you might want to work for. From a sector perspective, there's is it a space that has a history of sustaining growth during downturns, right? Whether it's a growth stage company that's been around for 5 to 10 years, or a company that is more mid cap, and perhaps was around in 2008. Is this a space that has weathered this and still has those signals of growth and value creation and sustainability? So, and then I think a lot of the same sectors that thrived and survived, more than survived, during the pandemic cycle, where early on we were going through the same thing, looking at high burners and everyone extending runway, and can you get funded in this environment? What are the sectors that could and did, where strong M&A happened? Supply chain obviously remains a hot space, and tech that serves that market. There's favorable dynamics like recession risk mitigation, associated with the need for visibility of your supply chain and the security of goods. And there's so many examples like this. So it's an exciting job market to be able to, as a candidate at any level, step back and say, what are my must-haves? What are my nice-to-haves? What's going on in the market that interests me? That serves me. We work around people every day where it's not just a job, it's a legitimate calling. That's the same thing internally for us as it is in our companies. But some people do just want jobs. And if that's the case, go nuts. But I'd rather people be really thoughtful about the funding environment and the growth profile of these companies, and the opportunity for the business, for individual career development, and for wealth creation, right?
What is your biggest piece of advice for the first time founder, right? You mentioned it's the CEOs who've raised money before, they understand some nuances. Maybe the first time founder that hasn't raised money before, they've never done this before, this is all new, they can get taken for a ride, right? You learn the hard way. What's your biggest piece of advice for them?
I would say, most founders don't remember the price of their, when they finally sell their business or recap their business or have some major liquidity event and exciting milestone for the business that they've built, they don't remember what their Series A valuation was, right? Like,
it's a good point. You only remember the exit. Nobody cares what it was a few years ago. Yeah.
Who cares, right? Yeah. So I think everybody's just been.
But the obsess at the time. At the time, there's a big obsession with Series A, and then the exit. It's like, oh, I guess I don't know why did we waste so much stress and time on that.
I mean, if it's the only round you raise, which sometimes with our companies,
a lot of times it is,
you're going to remember it.
Yeah.
But if it's a company that continues to raise capital and goes through different iterations, like, it really doesn't matter in the grand scheme of what you're going for. So I think you really have to look at, does find a partner. Do they understand your domain? Do they understand the stage that you're at and what you need to do to get to the next one? I think having people around who not only can be super helpful from a capital formation perspective and, what is this journey going to look like and navigating and scaling the growth from an investment perspective, but also from an operating perspective. I mean, I might have been the first original, hire with operating background in our firm, but we've hired half our partnership now, or has profiles and backgrounds like mine, and we've hired more of them, and we have multiples of operating partners from when I joined before. It's part of the formula now, especially in growth equity, where the founders and CEOs, they should be expecting a personal connection, and you got to get comfort in that relationship, right? But what ultimately makes an investor credible and helpful is kind of that intersection of domain and stage, and hand in hand with the stage in that domain is how can they help? And it's got to be.
It's not just the money. How can you actually help?
It's got to be more than capital.
Anyone that watches Shark Tank has heard those pitches. Like, hey, that guy can give you the same amount of money, but I can get you into Walmart, right? I can get your product sold, or I can get you advice.
Yeah.
That I'm in your industry. So I think you're right. It's all these.
You're hiring. Yeah. You're hiring your investor. That's just as you're hiring an executive for your team. You're going to be on that ride together from anywhere from maybe 3 to 10 years. Who you want to be with every day working in this business. It's no different than hiring your first CFO or any other, your chief revenue officer. I mean, you're hiring these people.
That's a good way to think about it. If you flip it as like you're hiring them rather than you're begging them to give you money, right? Like if you change that perspective, all of a sudden you make a different assessment of how you do it.
It's a two-way street. We're selling to,
what's the numbers? Like, what's the percentage? Like for every one company you invest in, was it 1,000 companies pitched to you? You met with 50 of them. Like, what's that pyramid of how many you even hear from before one gets money?
We're tracking 6,000 on a 12-month basis. Or is it a 12 or 18-month basis? About half of those turnover, like somebody else funded them, or they went out of business, or they're slower growers. There's probably 1,200, real companies that we meet with a year.
So 1,200, it's like 100 a month. So let's say out of 20 hours, like 5 a day, like every day, 5 companies are getting a meeting. Yeah.
At least.
Yeah.
Especially in Zoom world, right? Because you can do that many more now.
And is this just you, or this is like on behalf, like all of Edison's number that you're giving?
The investment professionals at Edison.
Okay.
Yeah. No, that's not me.
I was like, that's too many meetings for you.
It's a lot. Yeah. I have other responsibilities other than investing too. And we do 6 or 7 a year.
Okay. Oh, so all right. So 6 or 7 a year out of that original 6,000 number. So it is like that 1,000 to 1 ratio. That
But we get to know these companies. It used to be for like 30 months before we invest. Now it's
Wow,
down
that's a
in this, and
long relationship of getting to know you before just handing over
I
money.
mean, it is a huge part of um, getting us to the top of the list, either when they finally decide to raise, or if we can convince them along the way, you know what, now would be a great time for growth capital. Yeah, it used to be 30 something months. It's now 22. But it's our business is not only a long game once we get the money in, we view it as a long game and getting to know them early and starting to build that relationship.
How much does your gut matter in terms of which ones to invest in, which ones to avoid? Has there been times where you thought, okay, this one's definitely going to work and it failed, or vice versa? I'm curious about that decision making, the Monday morning quarterback on the decision making, right? The gut, like, here's what I thought, here's what was right or wrong, or the ones that got away. My other partners didn't let me invest in this, and I knew they were going to be good, and there it was. Like, what's that game going on behind the scenes?
Yeah, I think about the different styles even across our partnership. Like, we probably all approach it slightly differently.
Which is good. If everyone approached it the same, then you wouldn't need all these people. Like, you want the
Yeah,
diversity of thought. Yeah.
yeah. I think I'm a gut. I focus on gut for sure. I haven't been doing this as long as a lot of my partners. I've only been in the firm 8 years, and um, so I can have a gut on the market or the problem, um, and I can have a gut reaction on the CEO, like some connection to who they are, what their capabilities are. Um, so that kind of gets me to lean in. But then once I do, we rely on data, and we need that to bring it forward and get more eyes on it. Um, and the companies that we invest in are more mature. So it doesn't have to be a gut instinct like a venture investor, because we have more data to work
Right.
with, and we can
It's less of a
see,
gamble. It's more informed.
yeah,
Right.
the repeatability, even some predictability in the business. So it's a lower risk proposition, but I think the gut gets you leaned in initially.
What's an example of a debate behind the scenes among the partners of, like, okay, Kelly likes it, someone else doesn't, or vice versa? What would be the kind of thing that would cause like a not unanimous opinion on what we disagree about?
Um, the readiness for growth capital,
Okay.
right? So, um, product will be ready. Has to be. We can't be rewriting things, replatforming. Like
Like, I don't want to hear about a pivot. Then you're not ready
no,
yet.
no,
Yeah.
absolutely not. But that's not even coming. That's not even coming forward. Um, I would say readiness of leadership in certain functions, like, finance, but especially go to market. There's, we had a company in this week. We're very excited about the investment. The person leading revenue has been there a hot second and doesn't really have a fulsome plan yet. But yet the majority of our capital is supposed to go into sales and marketing, right? So what are we doing to get comfortable, and we can be helpful and get prescriptive and drive alignment and then figure it out and go. The company already has a flywheel going, but are we betting on that flywheel, or are we betting on scaling this in a new and better way, and recognizing there's a lot of optimization? So sometimes we'll go back and forth on readiness factors. Sometimes it's the CEO. How long do we think they can? How far do we think they can take this? And it's not common for us to come in and bring in a whole management team. I mean, we did that with a control deal last fall that I led, but the founders wanted out. So, and
Like,
we
they just
had
wanted their money and they wanted to go away.
a turnkey team ready to go. So So that worked well. That almost never happens. But the CEO, if there's questions about the CEO, and we might debate about why someone thinks they're up for it and for how long, and no one has a crystal ball. So then the best we could do is surround them with the people who help mitigate the risks. And then there may be debate around, what does the board look like? What does the executive team look like?
To kind of augment weaknesses, right? How do we really harness their strengths and maybe help them on their weaknesses, and then put people around that? Okay.
But it's all execution. And as you can imagine, when you've got in our partnership, basically 50-50 investor operator with experience doing both, half the team coming up through operating, half coming up through investing, you get the different lenses, but it's really productive. And we lean on each other a lot for those different kinds of expertise.
Do you still refer to yourself as the operator or the investor? Which bucket do you put you in now that you've been doing both?
I'm both.
You're both. And then just real quickly,
the best job ever.
Made just for you. And then again, as we said, like, only 6 or 7 are getting an investment, and you have so many other responsibilities. Just real quickly, because again, the outside world sees this more as like, oh, they give money and they go away. But is a lot of your time really working with the portfolio companies that you've already invested in and helping them, talking to them? Is it really less about the new ones coming in and more about the ones we already have? Like let's get them up to speed. Forget the new ones. We got to focus on the ones that are already here.
Yeah, it's cyclical, right? And we're at some point in our days, you're touching a different part of the investment cycle. I have several boards. I'm involved in, we have a new fund, with 6, going to be 7 investments in the ground. So we're all very focused on deploying that fresh, new capital commitments from our LPs in our Fund 10. But we're also, the exit environment's been a little slower. We had multiple companies in exit processes, particularly with public strategics, that started to slow down as, some of the downturns dynamics. But, we still have to be delivering liquidity from older funds to our companies. So there's a lot of work around portfolio management and exit forecasting. There's, I'm responsible for our Edison Edge value creation platform. We obviously have, a lot of folks kind of programmatically, as well as expertise, operating partners that power that platform. And they're helping existing portfolio companies. And that ranges from 180-day post-investment plans for our newest investments, helping them get a fast start post-investment on, mitigating that execution risk. And then there's companies in the portfolio. Some of them, we're getting them exit ready. Others are doing tuck-in acquisitions, and we might come in and give the team some leverage on integration planning and managing the integration of that M&A, because they don't have that experience on their team. So it's any active portfolio, we're in there. But it just depends where they are in the cycle. And sometimes there's meaty dig-in projects at the board level or at an operating partner level. And sometimes it's like, hey, do you got a playbook for this? We're doing it for the first time. Can you toss it over? And that's easy, right?
The cheat sheet. You have a lot of work to do. I better end this podcast so you can get back to work. You are very busy. Kelly, thanks so much for the time today. Really eye-opening conversation. Appreciate your perspective. Thank you so much.
Thank you.
Thank you to my guest, and thanks for listening. Subscribe to get the latest episodes each week, and we'll see you next time.